Corporate financing presentation. Use of rights in financing company. Get ready, it's time to take our chance with corporate finance. Rights offering. The general scenario related to a rights offering would be a situation where a corporation wants to get cash, wants to generate capital, would like to do so by issuing common stock. However, the initial offering having already taken place, there are common stocks on the market already at this point. So if the company issues more common stock, the current common stockholders might see it as diluting basically their percentage ownership in the corporation. Corporation might then give the existing shareholders through possibly a rights offering the ability then to purchase the new shares that are being offered by the corporation, possibly at a discounted price, and in so doing, then being able to keep their current ratio in the corporation constant, possibly as a percent of the total stocks outstanding, which could be a positive benefit in terms of the voting rights that they might have as owners of the corporation. Now, note that when we're thinking about issuing the rights at some price that's less than the market value, then there's a lot of questions in terms of what's going to be the actual market value per share or the earnings per share and different types of calculations during the rights offering and at the end of the rights offering process. So we're usually thinking of the rights offering as a process. It's going to have the offering period, and then it's going to have some termination point at the end of the rights offering. And we want to think about the consequences as we go through that point to the end point and think about, okay, what's going to be the market price per share? What's the end result of the rights offering process? But in general, rights offering is a group of rights offered to existing shareholders to purchase additional stock in proportion to their holdings. It is an option because it gives the stockholders the right, but not the obligation, to purchase additional shares in the company. So they're allowed to purchase the additional shares, but they're not required to purchase the additional shares, thereby having the opportunity, if they have the cash flow, to purchase the additional shares and basically maintain their position in terms of the percentage ownership in the corporation. The subscription price at which each share may be purchased is usually discounted relative to the current market price. So in other words, you have the current market price, and the subscription price, the right that the right can be used in order to purchase new shares at, then is usually going to be something lower than the market price. Again, this could have some impact on what we think the market price is going to be at the end of this whole process, given the fact that the company is going to be receiving cash, and that therefore you would think the market or the equity in the company would go up, the value of the company would go up, but the cash being received is not equivalent to the current market price. So you would think the market price per share would go down. So those kind of determinations are really useful for practice problems. We'll work multiple practice problems in relation to this so you can get a feel for what this does. Rights are often transferable, allowing the holder to sell them on the market. So remember, as we go through this rights process, they're going to basically declare the right, and then at some point in time, you might have a situation where the rights are actually transferable. And you can think about it when they offer the right, if there's a right as well as the actual share itself, you can kind of try to break those two things out and think about the two values basically separately, and then at some point actually be able to sell, the holder being able to sell the right on the market independent from the share. So use of rights to financing questions. How many rights are needed to purchase one new share? So this is going to be a common type of question that the corporation will have to determine and will have to be known basically when we do the rights offering. In other words, we have the existing shareholders, and so you might think of this in terms of, okay, how many rights are we going to give? Usually, oftentimes, most of the examples we'll have here are basically one right per share, and then they're going to need so many of those rights in order to compile them together to buy one new share. And that's how you basically have this situation where the ratio of they're going to give the ability to buy new shares based on some kind of percent ownership by forcing the owners to then have multiple rights, given they're going to get one right per share most likely, and then need multiple rights in order to purchase a new share at the discounted price. So what is the monetary value of one right? So once that happens, then we need to then start to determine, okay, now this share has a right attached to it, which we might call right on. It's a share with a right on. And that means that we could value this or try to think about it as components, where we have the right and the share and try to break out the value that would be attributable to those two separate things. And at some point in time, then we could have a situation where you can actually sell the right and as a separate, basically component on the market. When you think about the value of the right and the value of the stock, you want to think about it as a process, because you're going to have the process of the offering of the rights, and then at some point in time, the ending of this whole process. And we want to know what is going to be the value of the stocks and so on at that point in time. So question then, what is the monetary value of one right? So if we want to think about the value of the right itself, we can think about this basically in two different time frames typically. So when the rights offering is announced, the stock initially trades rights on, meaning if you think about the market price before this whole place happens, that would be the market price. Then they announce, then you have the rights on. So you could have trading of stocks with the actual rights included within it, which you would think about generally as the same as the market price before the rights offering took place generally. But now you want to think about allocating between the two components, between the rights themselves as well as the stock value itself. It could be useful to think about those two things in terms of two valuations, even though they're trading rights on, trading basically together. So we're going to call this the rights on, the cum rights period, which is going to be equal to the stock price minus the rights subscription price per share divided by the number of rights required to buy one share plus one. Now, this formula will make a lot more sense if you do calculations with it. We'll do many different calculations in our practice problems section to get an idea of what is happening here. Then we have the buying shares with no right, may be called the X rights. So at some point in time, you could then have the shares that were selling then without the right attached to it, and possibly at that point in time then the rights themselves possibly being sold separate from the stock itself. Now, when that happens, of course, you would think then that the value of the stock itself would basically go down. And we won't get into a lot of detail on this. It works a lot better if you look at the example problems. But the general idea is that if they're selling the stocks, if we're going to be selling the stocks at a price that's going to be less than the market price, which it will happen due to the fact that we have this discounted, the discounted price, if we were to purchase with the rights, then the company is going to be taking in cash, increasing the value of the company, but something less than. They're going to be taking in something less than the market value. So you would think then after this whole thing takes place that the value of each individual stock then would be going down at the termination of this whole thing. So at this point in time, we're going to say the right value during the exercise of the rights period. It's going to be the stock price, but once again, the stock price could be different at this point in time than it was up top when we're talking about the rights on stock price. Now we're talking about the stock price with X rights without the rights on, minus the rights subscription price divided by the number of rights needed to buy one share. You can see the difference here. We don't have that plus one. Once again, these formulas will make a lot more sense if you work through some practice problems. They'll kind of come together for you. So work the practice problems, take a look at them. Rights offering benefits. The position of the current shareholder is protected regarding the voting rights and claims to the earnings. So why is this going to be beneficial? Because if you're from a shareholder perspective, and especially if you're a significant shareholder that has basically influence in the company, then you're going to be concerned with the dilution of your voting power within the company. So if by giving the rights offering, it allows the existing shareholders the opportunity to maintain their percentage ownership, and so you can't have that kind of what you might think of like kind of like sneaky situation where the company basically, or possibly the management, issues shares, and it kind of distorts the ownership percentages and that kind of thing. Also, they have the ability to basically purchase these shares to maintain the value of the stock ownership, which once again could change a bit due to the fact that they are possibly issuing them at that discount. But they also have the ability to not purchase the new shares and possibly get some benefit from selling the actual rights on the market as well. So it allows the company to generate capital and have a preset market for new security issues. So if we're on the company side of thing, we're like, we need cash within the company, we need to generate capital. You want to be issuing stocks possibly, and the fact that you could basically give this kind of discounted price to the current shareholders, and the fact that they're going to basically want to possibly maintain their percentage ownership gives you that market that they're more likely to be purchasing for that reason. So it could generate large market interest than the normal public offering. So because of this kind of situation, this discount situation, you could actually have an increase in the market interest for the offering than you might otherwise have. A stock purchased through rights offering generally carries a lower margin requirement, so the cost of it could be lower as well.